Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we review the September level of building consents, look at term deposit rate changes, update what's going on with our risk premium, and we'll wrap up with what the other media are reporting. There were just over 2,000 new housing building consents issued in September, down about 500 from the same month a year ago and down 400 from the previous month. And one significant reason was the dramatic fall in the number of consents issued for apartments. That dropped to the lowest level ever this decade for a September, and only a Christmas holiday period in 2003 was lower. However, it was not only low levels of apartment approvals that dragged the level down. Consents issued for new houses were low as well, lower than the previous month, lower than the same month a year earlier. The value of housing consents was down 10%, and the value per square metre approved fell also, although the average size seems to be holding at about 200 square metres. We would have expected the average size to have bumped up a bit more than it did, given the very low number of apartments included. So this suggests that it's the top end of the market that's being affected more than the middle. The other thing to note in these numbers is that most of the decline has come from the Auckland region. While there has been little movement in term deposit rates over the past couple of weeks by either banks or finance companies, the Best Bank benchmark remains high at 8.75%, and finance companies are struggling to maintain a decent margin for risk above that level. Banks tend to pitch their best offers at 1 year or less, and this makes sense for them because so much term deposit money is held at terms of less than a year. But finance companies are only competing for about 15% of the term deposit market, about $12 billion worth out of a total of $85 billion market, and they tend to focus their best rates at the 2-year term. It makes further sense for them to do this because it helps them manage their liquidity profile. Finance companies tend to lend for terms of around 12 to 18 months. Having deposits with a 2-year term enables them to ensure their maturities come after they've collected on their lending. It needs to be said that finance companies have the best maturity matching management of most institution classes. That said, as our chart shows, while finance companies have continued to raise 2-year rates and banks haven't, over the period when finance companies have come under tough market pressures as a group, they don't seem to have raised their offers anywhere near enough to restore the premiums that were on offer by them over banks just 2 years ago. It looks to us like at least another 0.5 to 1 percentage point needs to be accepted by finance companies. Some have moved there, but some of the majors have yet to do so. Yesterday we pointed out the conclusion by Dr. Bennett that currently fears of recession outweigh fear of inflation on the international scene. This is highlighted today by our risk premium review. The 1-year US Treasury bill yields have fallen below 4% for the first time since September 2005, when the Fed was holding rates down to stimulate the US economy. The 5-year US Treasury bond yields also fell with a similar thud, holding just over 4%, which is also a long way down. Both benchmarks have fallen 25 basis points in just over 14 days. These moves have pushed our risk premium up to an impressive 4.7% for the 1-year maturity and 3.95% for the 5-year. It has been a very long time since we were last at these levels. We're now at great risk of being exposed to rising international credit costs. While the recession fear outweighs the inflation fear, and that manifests itself in a continued flight to safety and falling bond yields, we should be okay. But that situation will turn, and the new levels of risk premium being currently built into lending to New Zealand borrowers will be added to rising benchmark rates, pretty much like what is happening to rising crude oil prices. However, that turn could be further off than we thought a few weeks ago. The Fed is likely to lower its Fed funds rate on Thursday, and some see the possibility of another consecutive 50 basis points drop. And finally today, a quick look at what the other media are reporting. Geneva Finance has refunded almost $600,000 to over 900 customers following an out-of-court settlement with the Commerce Commission. Investors wanting to gain access to their money on a short or medium-term basis should think twice about putting it into alternative investments like unlisted property, hedge funds, forestry or infrastructure, an investment specialist has warned. Christchurch-based independent mortgage lender Morehouse Mortgages has received an Islamic religious ruling from the Federation of Islamic Associations of New Zealand that its Manzil home ownership package is halal or approved in accordance with the Islamic religious principles. It'll be marketed by Global Home Loans. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.